Number 2 of 5 live conversations. Give me a second, folks. As always, I want to make sure that we are streaming across my accounts as well as Anthony's. For those of you that are starting to watch this live, I'm sorry there's nothing else more interesting. But you'll hopefully enjoy this conversation. Whether you're watching this on my accounts, on Anthony's accounts, whether you're watching this on X, YouTube, LinkedIn, any platform you're on, we can see your comments. So to the extent that you want to engage with us live, have a question, don't hesitate to put it on whatever platform you're on. We'll be able to see it. I'll try and bring it up. Makes my job certainly easier as a host to have people that are helping me with the questions. But I'm excited for this conversation. I've tracked Anthony for a bit of time. He and I did Space, I think, a while ago. And I think Anthony was on your show a while ago as well, if I recall. So we'll have a good back and forth here. Talking about divergences, which might have something to do with me saying small caps hold the key. So with all that said, we'll get into it. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the rough hours, Anthony Crudele. Anthony, a lot of people are familiar with you. Obviously, you have a solid trading community behind you. But talk about who you are, what's your background, what you've done throughout your career, what are you doing currently?
Well, I started on the floor. I saw your interview yesterday with Jem, which was great. I was he and I can relate a lot. He's a lot smarter than I am, so maybe we can't relate that much. But I actually, I love Jem. I think he's one of the best in the business when it comes to options. He's definitely my go-to. But he started on the floor in '98. I started on the floor in '96, but totally different floors. I was on the CME Group floor, runner in the meats, in the grains, not the grains, the meats. And moved my way up to the Euros. I was an ARB clerk in there. And then really quickly, early on, I became a member of the CME, Chicago Mercantile Exchange, as an IOM seat holder, trade S&P futures. I quickly, got on the screen right as the E-mini was launching. E-mini launched like around 97-ish, mid 97-ish. I went through membership in 98. I was 20 years old. And I quickly started trading the E-minis because I was not a great pit trader. Had a good career there. Fast forward, you talk about health a lot, Michael. A lot of people probably know my backstory. I had a heart attack at 36 years old at my trading screens in 2014. Really a lot stemmed from that, to be honest with you. It's probably why I'm on the mic today, just because I had to take a step back from, just being the intense trader that I was for 16 years at that point, and just really kind of look at life from a different angle. I had a lot of success to that point, but you're constantly putting pressure on yourself to be better, make more, do more, and you're in solitary confinement basically in your screens every day, and so the stress just got to me. I didn't have cardiovascular disease or anything. People ask me this all the time, and so I stepped back. I started a futures radio show, probably one of the first, if not the first, futures podcast I think out there. It's been 10 years. I had a lot of success with that, and moved on and doing some other things current day. Doing a lot more media, still trade on a regular basis, but I'm not a short-term scalper anymore. I'm really more of a swing trader and primarily focus on the indexes.
So first question that comes to mind is why focus on E-minis? Why focus on futures as opposed to just doing the actual S&P 500 ETF?
Yeah, cost efficiency is number one, tax implications. Both things are really important. I think that also because I came from a place where I learned futures first. In Chicago, it's a futures place, where it's, if you're going to be on the floor in those days, you were going to be on the futures floor or an options floor. I didn't start in stocks. I don't really day trade stocks at all. Sometimes I do, but it's very rare. And I found a niche within indexes. And I think that, I go back to capital efficiencies. I think that tax implications, 60-40 rule. If you don't know, go and Google it. I'm not an accountant, but I will tell you it's much more beneficial to be trading S&P futures. If you're going to be a full-time independent trader, it's just better, I think, all around to focus on the futures markets. But, they are a lot riskier. That's just the truth of it. I don't know, people don't want to talk about that, but they're a lot riskier because they're a naturally leveraged product.
All right, let's talk about leverage because that is one of the appeals of using futures contracts. What kind of leverage do you typically take on as a percentage of your collateral? How do you think through how much leverage do you take?
For me at this point, I would say I use the overnight margins for indexes basically as my intraday day trading leverage as well. So if it's right now, I think it's somewhere around 17,000, we'll call it for one E-mini, something like that, for overnight. And intraday, it might be as low as, I don't know, $500, right? I mean, something lower in some cases too. Micros, I think could be like $100. And so I don't do the intraday margins. So I really stick with whatever the overnight is, because I want to be able to hold that position into the overnight. And I think it really sets the standard as to how much I want to have in my account. So if I want to trade 10 E-minis and it's 17,000, I got to have 170,000 in my account. I mean, intraday, if I'm going to do a quick scalp, I will dip into the margin, because if there's a point of interest that I really like, I will take advantage of it. But because I'm not solely focused on intraday anymore, I want to be able to have the ability to keep the position overnight, which is why yesterday, I brought up Jem at the beginning, because I agreed with a lot of what he said about how options on futures. Well, he was not necessarily talking about options on futures, but I know it's kind of all bundled together. But options on futures, I think, are going to be a growing place in this industry. And I actually use options on futures quite a bit now to hold these positions. And so for me, a percentage of my account, it's different perspective than where you are, versus like my stock portfolio. Like my stock portfolio has, I've got a lot of my money is managed, and I have some that I'll trade, on my own, right? And so from that perspective, I'll be a little bit more balanced. Like I might have 5 or 10% of my portfolio in something. For futures, because that is a naturally leveraged product, if I want to be able to trade, 20 S&Ps, I maybe not carry the full amount of overnight margin in there, but I'll carry pretty close to it, at least 50% of it. So I know if at the end of the day I want to keep half that position, I will be able to keep it, or I'll go to the options market as well. And so a percentage of my portfolio risk on something like that is typically going to be right around 3 to 5% per trade. I mean, sometimes it's more, sometimes it's less. I mean, once again, it depends on the situation. I don't have a fixed amount of risk. I've talked about this a lot, because I believe that trading your money is made in moments. My best trading year was 2008. I mean, it's not even really close. I mean, maybe not in terms of total P&L, it's not been close, but I think in terms of my activity and the amount of risk I took and the amount of winners I had versus losers and all that, like 2008 was the busiest year, we'll call it, for me in my career. And it really kind of put me in a position much higher than where I had been previously. And, and the risk I was taking then is different than now, because in those moments, we knew the world was kind of coming undone. So I was just getting short with, full leverage, taking on a lot of risk. So in those moments, I took advantage of it. Like right now, I think we're going to talk about a divergent tape. I'm not risking 5 to 10% of my account in a tape that I don't have a clear path on. I will risk more when the situation presents itself. And when it's not, I'm risking less, because I know I'm probably just treading water until another moment occurs.
Let's talk about that. Until the path is clear. I always say path matters more than prediction. What month did the clarity end for you as far as the path of markets this year?
Probably August. I mean, August it's funny. I just got to a lake house. I spent the month of August in Lake Burton, Georgia, and I got there and I saw the market was down big. Of course, I had to log in and take a look at it. And it always happens on your vacation, right, Mike? It's funny. So
I will say real quick, that first week of 2016, I think it was like the worst first week for equities going back to the 20s. And I happened to be in Turks and Caicos. And it's like, really?
I mean, you can't.
I totally get it, man.
It's unbelievable.
Yeah.
My wife was like, "What are you doing, man? Let's go." So, that week, it really changed it, because I thought that was really a buy the dip opportunity. Not initially. It was later. I mean, I looked at it and go, okay, I had actually opened up my portfolio. I didn't trade futures that day, but I bought some stocks. September came and I saw the pullback and I'm like, oh man, this is kind of interesting. And I actually sold a huge amount of the stuff that I manage. I sold a lot of my stocks in September, in that little pullback that came back down. And I looked at it and I'm like, man, this tape is now really throwing me for a little loop here, because, you had a strong year. You had that big pullback in August, which typically you're going to get. I think August always has weak lows and weak highs. So I thought that August was a time where, I felt good about buying some stocks in that area, because I'm like, if this low doesn't hold, I know I'm wrong. If they take out this high, we probably go higher. But then September, the tape just got really choppy, and I'm going back and looking at August into September, and I'm like, okay, there's just a lot of divergence. Rate cuts come. Russell can't go any higher. You got what, 10 years today? What, 4.2? Mike, I haven't looked at it in maybe an hour or so, but you got rates starting to inch up. Russell can't catch a rally. NASDAQ is stuck in mud. It can't do anything. S&P and Dow continue to grind higher. Low volume, which doesn't make me bearish, but it's just like there's really not a lot of interest, we'll call it, up here, because I think it's divergence and we're at all-time highs. And I just think that this tape is, now I look at it and go, I kind of don't know what to do here. You know what I mean? You want to buy weakness, I think, for now, because technicals are firm. But I don't know, man. You start taking out September lows or even a previous, obviously August lows would change everything. But I think September lows gets real dicey into the end of the year. And I'm just not sure what's going to happen here. I really don't know. I don't have a clear path at this point.
So when you're in these periods where you don't have a clear path, you just sit and wait. What are you looking for to get that clarity?
What I've been doing, honestly, lately is like, past couple of days when, markets pull back, like I'll buy a few calls, in S&P, and, I wait for the tape to get weak. I look for support to hold. I've got, my short-term strategy. I buy some calls. I'm not really doing the outright futures as much, because I'm not buying 0DTE either. I'm buying like 1 or 2 days out, and you look for the bounce, rotate out of the calls. That's all I'm doing. So I'm using the weakness as an opportunity to get in, but because I don't believe in the story to be like long the outright futures where I would hold, I feel like I have a weak hand in a long. And so a lot of times I'll use the options market for that. I think it's just a much better tool, because if I buy 1 to 5 days out, I'm not going to get blasted if they immediately go against me. And if they start to rotate back up, you make a little scalp out of it. So I'm basically day trading options. And so that's what I do when there's divergence. I find the strongest tape, which is S&P and in Dow, but Dow options are just not they don't have as many expirations, a little bit wider on the spreads. But so I go to the S&P futures options, and that's what I trade, because I don't look at the chart and go, they're going to blow me out here by buying a day where we're down 0.5%, 1%. I think the options market's the best way to participate. If there is a bounce, I can make some money. And again, I'm just trying to stay afloat, right? Keep in tune until I see something clear, because I don't know when that will be.
You mentioned earlier use volume as an indicator. I wonder if you think volume is not as powerful an indicator over time, just because there's so many different ways people can get access to some underlying assets, whether it's the ETF or the individual position or futures. I mean, I remember reading the old school technical analysis books, and there was always something on volume analysis. Just given the proliferation of all these kind of derivative plays on assets, is volume really as important as it used to be?
I don't think so. I mean, yeah. I agree with you. I mean, we used to say in the pit we were the center of the universe, right? And that's totally changed. It's you got E-mini S&P, you got micros, you got SPX, you've got SPY, you've got all these options markets which continue to grow. And, you have no idea. I mean, you could look at it, in totality to see what it's doing. But at the same token, I don't think volume is an indicator, but I also will say this. I actually think that low volume rallies a lot of times they're more bullish than bearish. Just because a market has low volume on a rally does not mean that it's bearish. I think it's more that you're getting to higher prices and you're going to always have less activity. I think that when you get into more expensive prices, in the S&P, Dow, NASDAQ, I don't expect volume to remain high.
Is the simplest answer the right one, which is the clarity comes after the election?
I mean, most likely. I mean, but you never know. Markets will tend to move once I think that everyone is probably looking more and more like a Trump win. I mean, it feels like that, but in this day and age, I wouldn't bet on it. Yeah, I mean, because you just don't know. But I think that's probably the case. But at the same token, I mean, a lot could happen. I look at the 10-year and I keep looking at it at 4.2, and the Russell's getting clipped, right? You're seeing rotation today right now. S&P actually just took out last week's I know, see, the markets are moving. We're on lows, of course, Mike. But once again, we're on vacation when it's busy, or you and I are on live. And so you
It's
take
like
out last week's lows.
Yeah, it's like 2022, by the way, all over again. Here we go with yields rising and stocks going and small caps getting the brunt of the hit.
Yeah, I mean, so that's what I'm saying. I mean, you could have people start being forced to push buttons here. You're taking out a previous, week low. I think that, look at, for me right now, I talked about this the other day, below 58.50 in S&P. I mean, I'm not really interested in buying the dip. We talked about what I'm doing in Divergence. Now I look at this and go, I mean, could this thing fall 100 points from here, 50 to 100 points in the coming sessions? No problem, I think. And I go back to it. I keep looking at the 10-year grinding up. You hear more talk yesterday about Fed continuing on the path to cutting rates. 10-year saying, hold my beer. Inflation's sticky. I'm not a macro guy. I don't want to get into it, but I'm smart enough to understand that. And when I look at markets as a whole, I say you got weak hands. You got weak hands on the highs here is the way I feel about it. It doesn't mean I'm bearish. It doesn't mean the market's bearish. But have you been long and you see 10s inching up, Russell continuing to go down, small caps, if they couldn't go up after a 50 basis point hike and with the future dot plot looking like it's lower, when can they go up, right? I mean, everyone says wait for the rate cuts to come into play, but you never know, man. You come in, Trump wins, and Russell could gain massive traction with some of the things that he's talking about. It could be very, very beneficial. I look at the Russell a lot of times like gold. It does nothing for months or years, and all of a sudden it's just on this parabolic move. I mean, and look what happened. I think it was a year ago this time in small caps. They were up like 5%. They had the biggest up, what was it, day ever or something like that? Biggest up month maybe ever. And since then, what have they done?
And people forget that in 2020, a combination of the election, reopening trade, small caps had one of the greatest relative outperformance moves in history, no matter like a month and a half. So to your point, when it moves like hell, right?
Exactly.
But this is the challenge. So I myself am actually on a relative basis bullish on small caps because I think they're due for a cycle, right? But relative doesn't mean absolute, right? Meaning they can be down less because they discounted a lot of negative news, I think. And maybe the Mag 7 take the brunt of the hit because that's where all the gains have been, right? So that becomes more the source of liquidity. But I've been on this small caps hold the key line for the last year plus, I don't know, 16 months or so. And it's, we're going to get into the divergences, but that's the biggest, that it really does go back to that. Small caps clearly are worried about default risk. Yeah. Right. That's what which is higher for longer, rolling over of debt into higher rates. And again, we're back in a higher for longer mindset suddenly, right? With the way yields have backed up post Fed cut. But at the same time, credit spreads have been so tight. So one market says default risk is real. Another market says there is no default risk. One of them, I believe, has to be wrong. That's a divergence, right? Which is why I keep saying small caps hold the key. So whatever happens next to small caps will determine who's right and who's wrong. Right now, it still looks like small caps are right. It's just the headline averages don't care yet.
Yeah, and you know what? And I agree with you from a pure index standpoint. If the small caps cannot rally, at some point there's an underlying problem here. That, yeah, I think tech can stay bid, but S&P and Dow, I feel like that. Not to say that the small caps spill into the large caps. I just think that at some point, the stuff that's been doing really well, it only can go so far to where the people that look at valuation really start to take hold. I think that's where they may not get cracked, but if you continue to see the small caps, which there's probably a lot of people, Mike, I don't know, probably been buying this Russell. I'm one of them. I bought IWM. I bought it in my long-term account. I've rotated out of it 3 times. It's gone my way, come back. I put stops in. I get stopped out almost every time. I actually had a little run earlier, like in the August time where I caught it a little bit, but for the most part, you got to imagine that when those losses, if they could start to occur on a bigger scale, it's going to stop the other stuff from going up. Nonetheless, I've never seen a bull market in my 25 years as an independent go higher without all the indexes working together and almost looking very similar as well. You go back and look at every one of them, they almost all do. And so I don't need to be a genius to know that if the small caps suddenly start taking out previous month's lows, doesn't matter how interconnected they are to the S&P, who wants to buy a high? I mean, I don't.
Thank you for saying that, because I feel like I've been insane in this. Right, this I didn't think. I'll tell you something. Even my whole when I was, which I've been dead wrong on when going through my rant on Nvidia using that fun word repeatedly on X. The thesis all along was that the generals fall to the soldiers. So small caps were diverging around the time that AI mania was taking place. Right at the start of ChatGPT getting into the public narrative. And my thought at the time was small caps are the leader. They're diverging in a negative way, which means all the winners will at some point break. That's why I kept on saying Nvidia is that word, right? It didn't happen, obviously, right? But the divergence is still very real. Now, it looked like July was maybe a starting point for a turn, right? If you remember, you had that kind of multi-standard deviation spread differential. Small caps were up, to your point, huge, and large caps were down. Some of these stat R players got blown out for a moment in time, and then you went back to the Mag 7 large cap momentum only type of environment. What's it going to take to stop getting whipsawed in small caps? Because that's the real story. For all the talk about momentum, every time it looks like momentum's about to take place in small caps, it just doesn't want to stick.
Yeah, I mean, it's probably a clear path for what happens with taxes and a clear path for rates. They're small businesses. I mean, again, I'm not a macro guy, but I look at it and go, the Russell's just got a lot of work to do, I think, technically. And obviously, when you look at policy. And so at the end of the day, you're just not going to get, I don't believe you're going to get a clear path bull market higher in this environment coming into an election. What's also interesting is that we went from this, how long, Mike, of a cycle where Fed was easing, right, into a tightening, and then we're right back into easing, right back into cutting. And it's like the ship is so big that it just doesn't maneuver and turn as easily. And so I don't necessarily know where that ship is turning at this point. I think that's the most difficult thing, because I go back to it. The Russell could change on a dime. I mean, this thing could all of a sudden clear path on tax policy. You know who the president is. Once the market knows what they're working with, it finds a way, period. I always go back to that line in Jurassic Park where he goes, life finds a way. I always look at that as for the market. Once the market knows more of what's happening with policy and Fed, market finds a way to make money. That's what it's built to do. I think right now the problem is that small caps are, they're trying to find a way, but they just haven't yet. And that way may not necessarily be up. It could be down. And so I think that divergence is what is causing a lot of weak hands out. I mean, if you're sitting on fat gains in tech and you're looking at it going into the end of the year, I look at it and go, why not trim some? I've made the mistake of trimming some a little bit too early on several names, and I'm kind of just sitting here now hoping for a pullback. But at the end of the day, I still stick with my decision, because I just putting trail stops in my stuff. I cannot see any reason to add capital here. I mean, that's the difference. If I'm in at a great price, great. But I'm going to add capital here? I don't know, man.
I saw May Faber put a post out, how many times in history has the equity market been up 20% and gold been up more, 33, 34%, and the answer is zero. We've never had any year
I saw that
strong equities like that, and gold as strong as it has been. It seems like gold has been clearly saying risk off. Small caps have clearly been saying risk off. Large caps clearly have not been saying risk off. Utilities have been saying risk off. How do you even rely on signals in this environment?
I don't think you can. And, I look at gold, one of my mentors told me that gold is a hedge against central banks. Okay, well, it's a hedge against inflation. I own very little gold. It's on great, but really this year, the best hedge against inflation I've had over the last 2 years is Nvidia. I own Nvidia, I've owned Apple, I've owned other stocks, and those things have, well outperformed gold. Doesn't mean I don't want to own it. Doesn't mean that, gold is not doing what those people are saying. But I also was around in 2008 and gold went down when we went down. I remember trying to buy it on the way down. I was getting killed. It was probably my biggest losers at that time. I was short in stocks. I'm like, I'm going to buy some gold on a dip, and I'm just getting ripped. And so I think it's one of those things where, gold has always been a tricky market for me, because gold goes up when stocks are going up. I'd rather own tech. It's just from my experience, and I could be dead wrong. I'd rather own the best tech name in an inflationary period or in a period like this than own gold. And I always will own gold. I always own some gold just because I've seen it perform over the years. And I feel like I don't really look at it as a hedge. I actually just believe that, I'm worried about, other reasons, maybe global collapses in some ways with currencies to where I think that gold makes sense to always own. But I never look at it as the greatest signal for what's exactly happening. Now, mind you, it's coming from my perspective of I'm not a macro economist. I'm not a macro expert. I'm just a guy who's out there who's watched markets for many years, and I just kind of seen how it's performed. And it's just never given me any sort of clear message as to what anything I've been taught. I've always looked at it and said, I've done better in other scenarios in other places. Like I mentioned, with owning tech, if things are going up than that. And I actually, go back to I think even there's some commodities I'd rather own, like oil. I know we're not getting an oil, but it's like, I think, oil is another market that I look to, I think is for signals, I think is a better signal than gold.
What does that signal say right now when it comes to oil?
Oil, it's like all the macro people I watch keep saying how oil should go up and it can't. So I think it's a demand issue, right? There's a lot of oil out there. And if demand was so good, then why isn't oil going up? And so once again, I think oil is a true supply and demand issue because it's used in so many different things. And if there's reasons for it to go up, it can't hold any rallies. You've got geopolitical tensions. You've got all these different things where you look at a playbook. Yeah, don't get me wrong. I've actually scalped a little bit of oil here and there just because when you see it get oversold, you're like, okay, maybe it squeezes higher. It's not really been that great of a trade for me. Yeah, there's been opportunity, but everybody under the sun knows that, oil should do good in geopolitical tensions you think if also the economy is doing good, that would drive a big driver to see big moves in oil, outside of this range. But you look at the chart, it's doing nothing. And so that makes me question a little bit and go back to, it's just from a perspective of somebody who watches tape. And I look at it and go, kind of just can't hold a rally. Well, if we lost Mike. Just me right now. What's up, James? Don't know where Mike is. I don't know if he's in here, but might as well talk a little bit about, I think until we get Mike back, but actually getting a sell signal today on the Dow, on the daily. I'll probably post about that on Twitter. It's interesting with sloping moving averages, and you have a sell signal on the Dow. Tricky. Probably could sell the rallies in Dow, I think, right now. S&P is probably soon to follow. Taking out that low 50, big. Sorry, Mike. What's up, buddy?
No, sorry. My connection dropped off for a second, so I had to reset real quick. No, I think really interesting on the oil perspective. You mentioned in 2008 you had a killer year, and you were obviously aggressively shorting. I am very public saying I don't think shorting works over any prolonged period of time. But to your point about making money in moments, yes, people can make obviously a lot of money with shorting. What would it take for you to get some of that conviction that you had maybe in 2008 to take a real aggressive directional bet on the downside? Because every single time it looks like the S&P wants to, for a moment in time, break. It just doesn't.
Well, there's two parts to the way I'll short these days. One is I'll get a signal off my daily, and it'll be a short-term rotation, so a mean reversion and primary trend. Most likely I'll use options for it because I don't want to get caught, selling rallies in a bull market. The market's still a bull market, and we won't know if it turns into a bear market until way later. So trying to get the turn is just too tough for me. So I'll use options initially for a mean reversion. Where I would start using leverage short is there's the only way it happens is two things have to occur. It has to be news driven and it has to be technically driven. If you don't have both, then I'm not using leverage, period. I'll also get short for trades, small ones, but minimal. You need to have both because that's when the short side will work. In a massive way. Like I go back to it, probably 06 to 08 were my two of the best years in that decade for me. And it was really because I caught the up and I kind of caught the down, right? And it was because I looked at both scenarios was what was happening. You had a breakout in a very technically strong market in 06 and 07. And it was very clear. It was like I was just long, just pounding the pavement, right? And then in 08, it was like, okay, news driven, technical breakdown. And it's just like I was just at the right moment at the right time for that to take place. COVID was different. It was similar because it was news driven. And I was like, I remember watching it in my living room being like, wow, this feels like 08. And it felt like 9/11, I should say, which I traded during that time too. But it felt like 9/11 where you're just like, all of a sudden you're just kind of scared. And I just remember like 9/11 was like this rollover that went into like a doldrum of period. If anybody who traded in like 01, 02 to like 06, sucked. It was so difficult. It was like we just went into like this bear like kind of doldrum where like the economy was like the whole world had changed. You and I could have a whole podcast on that, Mike. But that's what COVID felt like to me. And look what happened. It turned so fast that it was just like, as much as I had made on the shorts down, I got caught and gave back a huge chunk on the way back up because the news cycle was changing and it was just like a ripper higher. And so I'm just very cautious about using leverage on shorts, like just outright big futures positions where I would dip into, my day margin heavily, unless I have news and technicals, period. It's got to be both.
Some of risk management, how it's different with shorting. I mean, I get it. Conviction wise, you want to press it when it's there, but are you thinking about risk management differently? Like, are your stops tighter? What do you do when you're shorting?
I mean, kind of. Well, the thing is, it's like in a downward market, momentum is the key, right? If it's not working, there's going to be a lot of pullbacks in a downward market too, but most of the time, I'm just going to try multiple times. That's where you start using leverage, tighter positions, and you might get stopped out a few times. Like when a tape turns bearish, my stop should be tighter, but I'm going to give myself multiple opportunities. So from a risk management perspective, it's like I might be wrong 4 times, but the 5th time, I should make enough money to where I blow out the 4 times. Because if it starts to really go, then and I will press into those scenarios. A lot harder to do that in a bull market. So in a bull market, it's really different because bull markets don't necessarily give you good pricing to get in. So a lot of times I'm in smaller positions trying to take a piece of the rally, right? You're not getting as many pullbacks. You kind of have been as of late, I think, in a lot of single names, but in indexes, it's just like tight, grindy higher. And you're like, it's tough, So when the shorts come, and if it's a clear that I feel it's going down and I believe it's going down, doesn't mean that it will, but I believe in it. Well, yeah, I'm tighter and more active.
Talked about managing risk. Let's talk about managing stress, especially given what you mentioned earlier as far as your own heart attack and changes you have to do to your own lifestyle. Listen, for me, it's a function of I'm in my early 40s. If I don't turn things around now, when am I going to do it? Right. And I tend to be of the mindset that if something's worth doing, it's worth overdoing.
I've noticed that about you, Mike.
Yeah, I'm a pretty extreme guy from that standpoint. How do you manage stress? First of all, stress being long, I'm going to assume is very different than stress being short.
Yeah, they're different from that perspective. So there's two questions there, right? So from the short perspective, yeah, it's a much more intenser moment because if I'm really getting short, where I've like during COVID's last real time, probably I've been like that aggressive intraday. It's a whole nother level, but you're mentally prepared for that, and you're expecting a lot of volatility. I'm not doing it every day for years, and so that's different, and so in those moments, you're just kind of like, you're just so hyper focused on it because it's a moment, and because I've been through moments, I feel like I understand them better now, obviously, because I've been through them. But it's like, okay, like this is the time where like, dude, you got to ball up. Like this is it. The rest of the time, I firmly believe that the markets, too many people think that they're going to take something out of the market daily, weekly, monthly. It's tough. Yeah, it can be done. I think it's more of a younger man's game or, a newer person's game that feels that way. Because I've done this for a while, I look at it and go, I don't waste a lot of energy in a bull market, like trying to come in and squeeze out 5 points in the S&P or try to buy every dip. I try to find times where there's opportunity. I put the money on, I take the risk, and I move forward. right? And I don't waste my time or energy during times that there's not. So there's a lot of times where I'm not as active in a bull market because I don't need to be, right? Usually my stock portfolio, if my manager is doing good, he's like, man, I have a lot of his managers. If he's doing good, I'm making money there. And in my stuff that I'm managing for myself, I realize the tape is strong. I'm finding opportunities. I'm not forcing opportunities. Short side, a little different, because that window is small. It's not big. Short side windows are very small. And if you look at the scale, the timeline of when to really be short markets, it's, it's these little grayed out areas in a big, long timeline. And so you're different in mentality in that point. Now, on a day-to-day basis for me, how I manage stress, the easiest thing I will say, slow it down, man. Slow things down. I look at a lot of really the best athletes, and this helped me a lot. I went through, man, I had a lot of time down after my heart attack. I didn't take a lot of time down initially, but I eventually did a lot of introspection. And I looked at it and I said, and this even goes before that in my life. I looked at like, what are the best people? What's their common characteristic? And I had kind of done this before my heart attack, but it was like I took it really, really deeper at that point because I was like, listen, I'm just like too intense. And you can see me now. I'm a much calmer person than I was in my 30s and 20s. I was, pretty intense person. And so I've learned to slow things down. Look at Tom Brady. Look at the way he talks. Look at the way he acts. Love him, right? Look at Tiger Woods. Look at the way he talks. Look at the way he walks. Look at the way he acts. Look at Michael Jordan, right? Look at Federer. Look at the best people in any really situation. They slow things down. So I focus tremendously on slowing my heart rate down, period. That's the number one thing I focus on every single day. Breath, control, look at things with a stronger hand, because in these moments, I can make a decision by looking at something with clarity in that moment. The intense me was always just like, sold, buy them, different, reactionary. The new me has been like, I could see it happening even faster, but I'm not reacting as fast. I'm reacting just as quickly in my mind, if not quicker, but I'm able to make a better decision in the moment, because in the moment is what matters in this business. And most of the stress comes where people make mistakes in the moment that they know they shouldn't, and later they reflect on them and the stress just builds. I do less of that now.
It's hard to be like that. So like I used to work with a guy who would be very zen-like. Right? It's like whatever if it's not a great day, right? On markets, personally, he'd be very calm. Markets go down hard, even if it's a crash, be very calm. And I used to always have sort of a fundamental issue with that because I don't see how you can possibly regulate your emotions that easily, right? It's like, to me, it's more like, all right, well, if things are going well, it's going to be fleeting, most likely. If it's going to be fleeting, then enjoy it. Like, be excited, right? I mean, that's the opposite of stress. That's kind of the elation part of the business. How do you kind of cut off the extremes? I don't think it's that easy. I mean, it's easy to say it from the perspective of when there's losses, I take it unemotionally. But why should you be zen-like when things are going well?
Well, let's clarify a couple of things here. Number one is, can you control emotions? Can you control how you react to something? No, but you can control the moment right before you did something that you got the reaction. And so that's the key difference here, right? Not that, like, if I lose, I'm still equally as pissed off, and I still equally want to take a mouse sometimes and sling it against the wall if I do something that either I lose a lot of money or it just was a bad moment, bad mistake. The difference is how you slow things down and how you control emotions, even though I don't believe in that. And my friend Denise Scholl would not want me to hear me talk about that, but she understands exactly what I'm saying. I've had great conversations with her about this. Is really me knowing what I've gone through in the past, recognizing that pain, that suffering, that moment where I knew I made the wrong decision and did it anyway. And then later I'm pissed, chest is tight, headache, aggravated, miserable, right? To where I get in that moment now, because I've spent so much time breathing, slowing things down, taking my blood pressure down, taking everything down, that when something is about to happen, I have that little buffer period, that little bit right before I do something. So I'm able to live with that decision a little bit better now. because in that moment, I might have handled it a little bit better. I'm not reactionary to what people say about me. People send me things, do things, whatever. I can't think that way. I don't operate that way anymore. You know, somebody could come at me and be mad at me about something and, whatever. And I'm always going to look at it. I mean, obviously it's always dependent on situation here. We're talking in general. I really, my thought initially is let whatever is happening happen and process it for a moment, even though I'm taking it in real time, and really understand how you want to react. Because that's what it comes down to, right? And so it's about me just slowing everything down around me as a person. So as things start to happen in real time, I'm better at my reaction.
I love this post you put out. Trading isn't just about market timing, it's about life timing. And what you're hitting on here is different stages of life result in different risk tolerances. Talk about this, because I think this is something a lot of people don't really appreciate.
Man, I mean, life timing is huge. I look at it like when I first started to trade, I was 20, 21 years old. I had nothing to risk. I was living with my parents. I'm able to do whatever I want. I could go broke a million times. It didn't matter, right? As you get older, as things change in your life, responsibilities, spouse, children, animals, home, every single moment that I bought something and added something to my life, my mindset changed. And so in those moments, it's like I'm a different person. Maybe not a different person in the way I was, as a trader, but I'm a different person in my life. And so now what I'm doing is all going to be reflective of that. I mean, as we grow, trading is not, it's not linear in your path. And it's also due to the mere fact that your life is going to throw things at you in different times. That's going to impact how you handle things, what your risk tolerance is, what your goals are, how are you living your life. I mean, as a trader, isn't it? If that's all you do is this, there's so many things that are going to come across in your life that you're going to be like, look at, I remember I was blinking and my life went by in my early 20s. I wasn't drinking. I wasn't doing drugs. I wasn't doing anything. And I had anxiety, and I'm sitting there like, I'm miserable. All my friends are out partying. I'm sitting there like, I don't even know what's going on. Like, this is just awful. And it's just because at that time of my life, I wasn't, separating church and state, we'll call it, right? I wasn't separating what, I was so in tune with my business that it was just like life had passed me by. And then all of a sudden I'm like, wow, I'm starting to make a little money. I want to live life. And I don't know how to live life. What do I do? And then all of a sudden you go and you buy a new car or you buy a house, and all of a sudden you're trading and you're like, oh my God, I'm thinking about my house. And I'm just like, you're just like, what's going on here, right? I mean, I remember my buddy, when I first bought my first house, was like, dude, don't trade tomorrow. I'm like, why? I'm like, boom, get killed, right? Remember, there's a story about me. I was, texting, or I was on my phone in Florida on vacation. I go to look. I was staying at my parents' condo, and I went to go look at homes. I go, let's just go look at condos with my wife. Let's go look at homes. Next thing you know, I'm on the beach with her. She's on the phone with the real estate agent, and I'm losing 25,000 trading S&Ps. Next thing you know, it's like, what am I doing? Next day I'm at the pool. She's like, well, we're going to buy this house. We're buying this house. Next thing you know, I lose another 25,000. I'm like, oh my God, what is happening to me? I'm like falling apart here. Everything I'm doing is stupid, because all of a sudden now I'm thinking about this damn house. I got to pay this off. I got to do that. And so, something happens to you, my heart attack. I mean, I could go on, Mike, about this forever, because the reality is things are going to be thrown at you that you just, whether you choose to do them or didn't choose to do them, and things change, man. And in order to be able to stay in business, because that's been like my goal, from the beginning, and then it was like make a ton more, and then all of a sudden it was like, well, stay in business again. You're gonna have different things happen throughout your life to where you start to. I go back to it. It all stems back to me as like slowing things down. What am I doing next? Why am I doing it? What are my goals? How do I carve out my time for my trading? How do I carve out my time for the other things that I'm doing? You cannot do this until you've been through different life experiences. because you're never going to know how to handle it. I know that every time I buy something new, I mean, I have some habits that where I buy some things, of some high cost dollar value. And I'm always like, listen, you spend some money, relax here. And you know that you come back from vacation, you're a little soft in your thinking, you're a little, feel like you're all good. You're ready to get back. Take a day, and so you learn how to deal with all this. So I think life timing is it's so in tune with what you're doing as a trader.
Anthony, for those who want to track more of your thoughts, more of your work, track your content, where can people find you?
And Anthony Crudele on Twitter, anthonycrudele.com. Everything stems from there. Got a free Discord as well. I put out my morning note. It's free. Everything I put out there. I've got some super exciting stuff coming up that I'll be announcing on X here in the next probably week or so. I'm working on a really, really big project for the foreseeable future. And it's probably the most excited I've been about something. So follow me on X and wherever and stay tuned to what that is. It's going to be cool.
We'll do another podcast once that's live. I appreciate those that watch this. I have another 3 live streams coming up today. So please stay tuned for that. Make sure you support Anthony. I think a lot of real wisdom in what Anthony said, especially here the last 10, 15 minutes. Appreciate those that watched, and I'll see you next time. Thank you, Anthony.
See you, buddy.
Cheers, everybody.